Hello everyone and welcome to the Pivot Boss Masters core training, and this is the analysis portion for our intraday analysis, and it's part two of our intraday analysis. And basically we're going to continue on with part one and basically look at the additional key levels that offer some significant reversal opportunities throughout an intraday session. Today what we're really going to talk about also is just scenarios. So these are a lot of case studies and just what happens in a general market. So we're going to look at a lot of different case studies, footprint charts. We're going to look at regular volume bar charts with some footprint overlaid as well, so you kind of get the idea of what's going on at some of these levels. But we're going to kind of dig into a little bit more of, yesterday was kind of what these levels are in terms of the overnight pivot or the midpoint and those types of things. And today will be a little bit more about how to use it and the things to look for when you're engaging these levels in the market. So let's go ahead and get started with intraday training, which is part of the core training and analysis portion of Pivot Boss Masters. So if you recall, these are the key tools that I believe all professional traders must have, at least some knowledge of, and understand how to use them. And of course, these are the key price levels that mean a lot and the most to the market. So if we review from part one of our intraday analysis, for the most part, these are previous high-low close levels, whether it's for the previous session or the previous week or month, the overnight pivot, the midpoint, the developing midpoint of a current session, the volume-weighted average price, open price, initial balance with extensions, and the footprint chart. All of these provide various types of opportunities throughout the day. So really, we're not going to relive what each of these levels are. What we want to do today is just basically give you the point here that each of these levels provides various opportunities in any given day. Not every single day. Sometimes the IB will be in play more often than other times. Sometimes the open price is in play more than other times. At other times, the volume-weighted average price is in play. Your goal is to identify which of these key levels is in play. Look to see where or which prices are bid, which prices are offered, and look to engage at those levels and looking to squeeze market participants. So a lot about what today is going to be about in this training is more about understanding who's long where or who's short where, understanding what it looks like when the market forces kind of battle each other, and which of these key levels really stand out in terms of identifying some of these opportunities. So remember, there are all kinds of prices that we can trade in the market on an intraday basis especially, but our goal is to know what each of these prices are and how price revolves or trades around those levels, and then know how to spot those opportunities that highlight great reversals or breakouts and those types of things. And that's where we really jump into the footprint chart to learn more about that and read the real-time order flow so that we can further confirm these fade opportunities or breakout opportunities at these key levels. So we always have to ask ourselves, which levels are in play today? Who's positioned where? Where are the stops if they're wrong? And that's really what intraday trading is all about. It's about hunting stops. So here's the first chart that we're going to look at today. And really what this chart is showing here is basically a few key levels. Number one, this is a chart from today's market, because it's so perfect and goes along perfectly with exactly what we're talking about in this training. So you can see right here, this purple line is the overnight pivot. The overnight pivot, if you recall, is the 3 a.m. price point for any given market. So 3 a.m. Central Time, 4 a.m. Eastern Time. So that is the basic pivot right there. And depending upon your charts, it might be a little higher, a little lower. With volume bar charts, it shows 91s. Price immediately goes off for this level right here. Immediately goes off and drops. So when price forms a 3 a.m. pivot, the overnight pivot, and immediately goes offered, our inclination right away is that if price returns to that pivot at some point during the day, we should be looking to fade it. So right there, that's the idea behind trading some of these levels. Number one, knowing which levels are the ones to be faded or defended, right? And number two, just having advance notice that these levels are approaching so that you can then engage it, read the order flow, and then confirm an entry into that particular market. And so in this case, this morning, the first thing we talked about this morning was the fact that prices had been immediately offered away from the overnight pivot. As a matter of fact, Max mentioned it for us in the premium trading room where he said, hey, the overnight pivot's already been offered this morning. And right away, you know exactly what that means. If price comes back to it, you're looking to defend it. So as price approached the overnight pivot, what we're looking for when we're looking to fade resistance is right here. We're looking for buy imbalances to form at that pivot. And we're looking for those buy imbalances to become trapped. Those buy imbalances, if they go offered, would suggest that aggressive buyers have bought at unfavorable prices, and if they don't get paid, their downside sell stops come out. And so for the most part, you can see that right here in this chart, right there, you can basically line it up. There's the overnight pivot, and that's that little dip right there. That's this portion of the footprint right there. And what the footprint is showing us is the delta differential between the number of contracts bought and sold at a price point. So it's basically just giving you the volume delta, the differential, the imbalance there at that area. So if there's a lot of buy imbalances that come in and price immediately sees a rejection, then that would indicate that those buyers perhaps are becoming trapped in their trades. And remember, once you come into the market as a buyer, right, you leave as a seller. You're either selling for a profit or you're selling for a loss. So when price pops up here and you see this green right here rotate into that level and price pushes lower, that's your first indication that the market has already seen some sort of rejection at that area. The actual confirmation is on this bar right here where price comes into and through the level by one tick, a one tick new high, gets a one tick new high, sees a large couple of ticks with imbalances there. Those buy imbalances immediately go offered and price goes down. So think about it this way. If price is rallying, and you bought a whole lot of contracts up here and price immediately goes down, you're in trouble, right? You're in trouble. And that's what this is looking at. It's looking for those large imbalances to form at these levels. And then if price goes offered immediately, that rejection right there implies that there could be a stops run that leads to a momentum move in the opposite direction. So that's really what we're looking for when we're looking to confirm any move at any of these key levels, whether it be the open price, whether it be a Camarilla pivot, whether it be a previous high-low close or VWAP or whatever the case may be, right? What we're looking for is for price to push into a pivot and start to see some immediate rejection. Once we see immediate rejection, we want to see some buy imbalances build, and then we want those buy imbalances to become trapped, which would then perhaps lead the stops in the opposite direction to become trapped, and that would lead to that momentum move. So if you think about it right here, if price is pushing higher, right? Price is up, and the pullback right here defended by bulls. Price is up, the pullback defended by bulls. Each time they're defending here, they're putting their stops a little bit below the low, right? Then you get a push up, pullback, defended right here, and they put their stops below the low. So when price fails to get a new high right there, look at this bar right there. That bar is just below these lows. That's where the sell stops are. And boom, it triggers. They backfill with limit orders right here that absorb any rotation there, and then boom, you see a continuation downward. So this is textbook. This is very, very textbook when it comes to this. How meaningful? Oh, sorry. Here's a couple of questions. How many ticks before the imbalances would you consider them to be trapped and be looking for an entry? So on the first rotation, right here, this for me isn't quite trapped just yet. When this one comes up, obviously it comes against it, so this one is. But down here, if you're buying down here, it's not so much trapped. So this is more absorption that I see at times. The real rejection, to me, occurs about right here. And the rejection is not just ticks away from it, but it's also the time in which it's rejected at those levels. So if price can barely tick, it ticks one tick or two ticks above and immediately sees a swift move. That rejection right there is more what I want to see, and sometimes it happens faster than others. But if price kind of pushes into this level and just rotates a tick or two downward against an imbalance, that's not to me trapped so much just yet. But anytime you get this large of imbalances here on these highs and you get a swift move down, that's a much bigger imbalance and a swifter rejection. So that's why the second test is always the most important. The second test is always the most important. But here's where it really confirms, is about right here. And that's, right at that low right here. You see those lows? That's basically right at the low. And this is where you had short-term support on that bar, that bar, that bar, that bar. And you can see right here there was a lot of sell imbalances, which meant that there were passive buyers sitting right here with limit orders trying to defend that level and squeeze it. Well, when price came back to that level after this rejection, the limit orders have gone. The limit orders were pulled, and instead, when a bunch of buys came in at the market, those limit orders that were buy were replaced with sell limits. And now passive sellers are using sell limits to absorb that buy side demand. So when you have a huge imbalance that forms that support right there, I love it. I love it because if they don't get paid, the stops come out right against it. So when you look at it, it's a progression. It's number one right here, as in that one's the initial rejection, just kind of a little bit down. This is the major rejection in the pullback, and this right here, that opens up the floodgates. That's usually how I look at it, 1, 2, 3. How meaningful are the tails, especially on a volume rather than a time bar? I think the tails are still very important because even if it is non-time based versus time based, I think rejection tails are still important. So I think time based bars tend to form rejections more easily because they are time based. So if you see a quick move in one direction, you're going to leave behind a huge tail. Now, these don't necessarily have, volume bars don't necessarily have the time to create huge rejection wicks all the time because they form so quickly. So in a rapid, high tempo environment, these will form so quickly that oftentimes you don't see rejections occur with regards to tails. But I still think if you do find a tail, it's still significant. So fading support. Fading support. The same thing applies. What we're looking for up here, it's just the opposite. You want to be able to, first of all, forecast that price is likely headed for a potential reversal off of a key level, right? And so again, this is case in point right here in the premium trading room. We had Max calling out the overnight pivot here being offered, and then we had Scott calling out L3 at 79s as an area to defend, perhaps for a rotation higher, because we had the L3 cam there. So right away, it's already showing me that everybody's really getting a lot of these concepts right away. I mean, you see the push up, you see the rejection here, you continue down until you find rejection at a different area, and here's that area, L3 right there. So when we talk about Camarillas, we talk about generally using this intraday analysis and the key levels that we use on an intraday basis. Sometimes it takes all of these, right? Up here's where they're going to find resistance, so you're offering this area. Bulls were defending here, and then they gave it up, so then they came and defended here. So if this is the next area that may see support, as we knew, once this thing started melting a little bit, it was like, well, 79s are down there. Okay, let's watch it. So when you see price come into 79s, what you're looking for is some sort of rejection off that area, right? So immediately I'm looking for some sort of rejection. I don't want price to come there and just sit or start to go down through it. I don't want any of that right away. If I'm looking for a clean rejection, especially on a day like today, which was a fade the edges type of day, fade new highs, fade new lows, then you want to see a clean rejection quickly. And oftentimes what happens is right here. This is the footprint during that period of time. When price drops down, you're seeing some sell imbalances, and on the final two ticks, sell imbalances right here, and then price closes that range bar above, back above resistance, or back above support. And that's very important right there. So it closes back above the level, And then when it rotates back down, right here is another large sell imbalance. So this large sell imbalance on the rotation basically sealed anyone that was trapped on the tail. And then when price rotated higher again, you got more sell imbalances, and each of these sells were not helping price go down, so their buy stops come out, and that's what fuels this move up. And so when we're looking at that rejection right there, you can see these little tails right there, boom and boom, those little tails. That coincides basically with this little pullback in this zone right here, right? So when price pops up, it comes back and dink, dink, and then it goes. And so on that pullback rotation, you're seeing these large sellers. So you can see all these sell imbalances come in here, and yet price doesn't go down. So what that's telling you right there is that sellers are trying to get price to go down, and yet price is going up. That tells you larger passive buyers are absorbing that supply, and they're going to look to run the upside stops. The upside stops start coming out right here. Pushes up, the first pullback is defended, pushes up to a new high, pullbacks are still defended until we get back up, back to value. So when you're looking at this again, this slide right here is the first one we're looking at because it kind of sets the tone for everything we do. When you're looking at these levels and we're looking at our analysis, every morning you're looking at what key price is offered and what key price is bid right now. And then you're looking to see, okay, what type of day do I expect it to be? You're forecasting where price could go if we see a breakout, or where it might rotate to if we see a pullback. And then once price approaches those areas of interest that you have outlined as key areas that the market may respond to, then you just go down there and you look to engage those areas. Sometimes the levels are so clean and clear that you can just put a limit order there and forget it and just let it trigger, right? But sometimes you want a little bit more confirmation. When you have an area that's already previously been offered immediately, the first retest usually offers a high opportunity ambush entry compared to other ambush entry styles. So ambush entry would just be when price rallies into a level and you already have a limit order sitting there ready to trigger. And so as price comes in, boom, it triggers it and you're in. There's no retest, there's none of that. So when price gets offered immediately away from this level, you can already have a limit order sitting there ready to sell the retest. So that's one way too. You don't have to read any order flow for that. You just see what happens, right? And if you combine an ambush entry with a key LVN or combine it with some of these levels, it can be fantastic. But other times, it's much safer to look at the order flow and confirm with actual order flow with the imbalances, and that gives you a much better idea that this is a much more highly confirmed opportunity. And the first idea always and forever is, if you're trading rejection, bring it back to acceptance. If you're trading rejection, bring it back to acceptance. That's the first idea every single time. So I wanted to zoom in right now on the actual footprint chart, because this is the actual footprint chart that showed the rejection here at the overnight pivot in the ES. So this is where price rallies into it for the first time, so you can kind of zoom out and see it. And again, when you're expecting to fade a key pivot, the first time it rotates into that area, you want price to come into the area, and then you want to see a build of buy imbalances kind of slow things down, and then you want to see those buy imbalances start to roll over a little bit. There's always going to be a retest unless there's a significant rejection of some sort. There's always going to be a retest, so you have to watch for the retest. And on the retest, again, if price ticks one tick above it or at it or one tick below it, this is a huge, huge sell opportunity if a major buy imbalance forms at one of those price points and then goes offered. So I want to condition you so that when price rallies into a level that you're expecting to fade, when price does immediately pull away, look to see at that price point that had the significant rejection, and then look at that price point, or perhaps a tick or two in front of it, or maybe a tick or two above it. That gives you a little bit of a window, because sometimes you get double tops, sometimes you get a one tick new high, sometimes you get a tick or two lower high, and every one of those becomes a potential area to fade for that second retest failure type thing. So in this case, this is significant because it was a one tick failed higher high, and so when you get the one tick new high and it's rejected, these bulls that came in to defend prior support, as mentioned earlier, those bulls didn't get paid. More stops come out, and then rotations have buying balances, and those come out. And again, you come right back to VWAP. What about the airspace between the retests? Does that matter? Okay, so that's a great question. So typically speaking, I'm looking for airspace between retests. And that's usually something that I'm looking for when price is looking at a change of bias at a key pivot. So for the most part, if say price pushes through this resistance level, I'm looking for at least some sort of spacing here and here before the next retest, successful retest. In this case, spacing can be good, and sometimes it's not always necessary or required. So if you have a retest here and you're coming up, sometimes if you come back too far initially before you retest, that might be too much fuel that could actually lead to a push through that level. So sometimes when you're looking to fade a level, you don't want a whole lot of spacing. You want a quick retest that's quickly rejected. And so you have those types of topping patterns where you have an M double top, you have the one with a little bit higher high, and then you have the one with a little bit of a lower low or lower high. And each of those are patterns to look for when something like this happens at a key pivot. Because remember, 2091s was the pivot. So when price came into it, the initial rejection, and then boom, that rejection right there sparked the move back to value. Entry at confirmation or immediate. With regards to where the entry is immediately, it depends on how you want to enter this trade, as a scalper or as a day trader, or how, or sometimes you don't have a choice because you may have missed the initial trigger. I think again, I try to tell you what some of the best scalpers do, and then I try to give you additional ideas as well. The first thing is, as soon as something like this hits and price ticks one tick below it, or two ticks below it, you hit this and you print down 1 or 2 ticks, I can guarantee you at that moment, most skilled scalpers are selling it right there. That's how I was taught to sell it. So if you have this pivot and you come back and you come above it and there's a 1 tick new high with a bunch of buying balances and it rotates lower, put the market order and sell it right away, or put the limit order to retest the actual imbalance level. So there's two ideas. You either step on it right away or you wait for this level to retest and go. There's another way that I like to look for it, and it's right here. So it's basically when you see this rejection and price goes, this is the confirmation that support is about to give way, because you're at support and then you have a huge buy imbalance on the move down and it can't go up. That's telling you that the stops are about to come out, and you can see it push down, and then you can see it come back right to that area, and then it goes down. So a lot of times this is very, very organized. And that's the best type of market at times, is when this price action is very organized off these levels. But again, this right here is big, this right here is big, this retest is big. Each of those in and of themselves are areas to consider entries in a chart like this. You just have to know what are the types of entries that you can enter a trade, how to do it, and then see which opportunities present themselves during the course of that move. All right, trading kurtosis using the footprint. Again, many of you are familiar with this opportunity here. This was a fantastic, kind of trade that happened in the footprint based off of crude oil, a big time push up, a major 5,000 contract imbalance. And again, using various data feeds, you're going to see various reads on the footprint. Since I use an IB bundled feed, you're getting a large 5,000 contract print up here, where in actuality you probably saw a lot of those contracts get filled somewhere in this gap up a little bit, and then it prints it here, bundles it somehow. But for me, all intents and purposes, it highlights an area that's extremely important. So for the most part, kurtosis is an extremely powerful volume profiling, shape-based setup which, as you know, offers reliability, great trade location, and swift reversals. This trade, when retested, basically gets a huge reaction in the opposite direction because of what's happening here on the profile. This is a fat tail event where you have a huge tail, very thin trading, and then you see a major high kurtosis project off of that data point. That's kind of like seeing two outlying events nested inside of each other. You know, you got nested outliers there, and that usually, with regards to data analysis, those types of things, it really highlights major areas. And so this is what happened. You see a big push up, you can see a 25% key level right there, and it immediately rejects lower. So here's a big 5,000 contract buy and bounce. You see the big projection, and it immediately goes lower. And so when we saw this live in the trading room, that's when I said, look to defend it at it or 2 ticks in front of that level. That's the trigger. You see this thing go, and so you put your limit order right at that level or a tick or 2 in front of it to front run the level, and from there you look to defend and enter that trade and execute at that level. Once you see the first rotation, you're looking to scale, and then from there, wherever you have additional targets and whatever comes after that happens. But for the most part, this entry right here is so accurate at times. It can be quite scary how accurate it is. So when you find this giant ledge that pops off the profile and you see an immediate rejection to that price, the first retest within a couple of ticks here is a high probability entry. And so all we're doing here is identifying a major data point, kurtosis. And that's basically, you know, when you're measuring the peak of any distribution. And when that peak forms within a fat tail event, you know, a long tail in a data string, I mean, that tells you right there that this is significantly outlying, and that's when you could see reversals. So the idea here is to look for a large buy and balance, you know, and most of the time I'm looking at a volume bar chart. So the volume bar chart shows me, you know, those volume bar dojis, and then that tells me right away something big happens on the footprint and I need to look at it. I head over to the footprint and you can see what happens. But this is basically your blueprint for entering a kurtosis. Is when you see this happen and you see the big thing pop off here and an immediate reaction occurs, here's your trigger zone right there. Put your limit there and look to defend for a push lower. If, because there are times, this isn't a fail-safe type or a foolproof type of setup. There are times where price will come back, and if it fails to get a new low, then it will pop above that imbalance. And should it pop above, it will then become an important area of support that could be defended on the other way. And then at that point, you may see an expanding ripple off of that range, because if it does become acceptance, then you will see price ripple around it in order to build a proper distribution around it. Because if you break it down at its most fundamental core pieces here, if this is a large buy and bounce, just say if it's a large market participant coming in with huge volume, they're coming in to influence value, right? Because value is calculated by the number of shares or the amount of volume traded at a level. The more volume, the more value, because the more shares or contracts exchange hands between buyers and sellers. So that's a large buyer trying to influence price higher and create new higher value, perhaps. And if it's rejected immediately, you see price drop. If it's accepted, you see price either create value at that area or continue onward in a price discovery phase. So that's just a little bit more behind, or a little more detail behind the kurtosis pattern. All right, so when we're looking at identifying kurtosis in the chart, this is another trading kurtosis footprint chart. This is another type that occurs very, very often. Again, you're looking for kurtosis to form at the edges of a price range, because remember, these have to happen during a fat tail event. A fat tail being a price rejection zone where there's a low distribution of pricing. So remember, when we're talking about a volume profile and we're talking about the standard bell curve with VPOC right at the middle, this is the tail. This is the tail. And this is thick over here because this is where the majority of the volume traded. So this is where 68% of the market traded. Over here, this is the fat tails. This is the tail event. And those tails contain just 4.5% of all prices within this profile. Just 4.5%. So if our idea is to trade rejection and return to acceptance, then when price gets out here to a fat tail zone, that's typically, a rejection zone, unless we're transitioning to a price discovery phase. But when we get out to these areas right here, and then we see kurtosis, now you're getting a 4.5% event along with a kurtosis event, which has perhaps smaller percentages. And now you're having that, like I said before, a double outlier event. And that's where this thing really gets powerful. And so down here you can see price had dropped lower, and then you see a big, large sell imbalance form, and price goes bid up, even by little ticks, 1, 2, 3, 4, 5 ticks. Not by a whole lot, but 5 ticks. When price comes back to that same price point, an even larger sell imbalance prints right at that area, and then you can see what's left behind is a huge kurtosis there. So a data point with high kurtosis is seen. Remember, kurtosis measures the peak of any profile or distribution. So how tall is the peak relative to what it usually is? This would be leptokurtosis. Remember, lepto is when a peak is very tall. Platykurtosis is when a peak is very shallow. Lepto is tall, and then you have your basic D-shaped curve, which is a little bit somewhere in between. So this right here shows price came down, double tapped the bottom, formed a huge kurtosis, and immediately upon forming the double bottom, pops to a new high beyond this high right there. That's important. That's important right there. And now all of a sudden, rejected, because a kurtosis event shows, remember when we're talking about kurtosis and leptokurtosis, we're talking about an event that has a very tall peak in the middle with extremely long tails. And those long tails suggest rejection around one large data point. And so there's still rejection here and here. That's why I say these have a big time reactionary force that comes with them at times when they play out properly. And so when price gets the double bottom, it pushes up immediately. And so on the rotation, this is an area where you can engage. Obviously, again, as I mentioned, as soon as this data point prints and price pops up 1 or 2 ticks, the best scalpers are stepping on that, and they're lifting the offer right there. They're lifting the offer right there immediately. If price gets away from them, then they're looking to defend on the first pullback with sell imbalances for a rotation up. And so then every counter trend rotation that has sell imbalances will tend to get squeezed in the uptrending market. And so the idea right away is to identify that kurtosis, negotiate some sort of entry in here. Again, there's several ways you can do it. If you have a high likelihood that you're going to bounce, given these imbalances being super red here, a big kurtosis event, immediate double bottom rejection, all of those are very, very clear ideas that we could be headed back the opposite way. And so big time zone here. Kurtosis, a very, very powerful concept that can lead to some very high accuracy trade location and reversals in the market. And again, this doesn't happen all the time. So this is what I talked about before, is that some of these events, these are events that are rare events. And so when you want to trade as a trader, you want to trade those actionable events, event-based trading. So when this event happens, you're just watching the market. And when an event happens like this, you know exactly how to engage it. If there's not an event like this or one similar that you know how to engage, then you have to keep waiting until an event occurs. So just real briefly here, in terms of using the footprint chart for identifying opportunities, the best thing to do, again, in terms of identifying opportunities, is to look for trap market participants at areas where you would consider to fade. And so in this particular chart, you have an uptrending market right here, an uptrending market. And you'll notice This is crude from 2014, and look at the prices. When I was using Footprint, when the market was at 100 something bucks, it was some of the best trading I've ever done for crude. So I took a lot of snapshots at that time because it was such a pure market with so many great data points, so many amazing imbalances, so much flow, kurtosis everywhere, tradable events all over the place. And so I wanted to continue to use some of these just because they're still very, very valid and prove these points very, very well. But down here, what you see is price gets a huge sell imbalance right here, and that's at the 103.42s, 103.43s, and price immediately goes bid, leaving behind a huge data point right here. And that is kurtosis in the fact that it is a large peak, so it has high kurtosis. I wouldn't say that this is formed in a fat tail event, so I wouldn't say that this is a kurtosis opportunity, but it is a giant data point coming off, and still, regardless of the fact that it's not forming in the midst of a tail event, it's still very, very powerful in and of itself because it's volume. It's volume. It's a big market participant. And so when this big seller comes in and fails to get price to go down, their buy stops become at risk as price pushes up. And then now on the counter trend rotations, look at these sell imbalances that come in here. When price comes and pulls back, look at all of those sellers come in right there. And all of those sellers become fuel. These sellers become fuel for the next squeeze. Because again, when you're thinking about 90 contracts short, 50 contracts short, 400 contracts short, plus all this, and price is not going down, that tells you that a larger passive buyer with limit orders is absorbing all of that supply. And if these sellers don't get paid, they leave the market as buyers, and the buy stops will come out. And that's what leads to this move up. And so when price rotates again, more sell imbalances, right? And that helps, again, another rotation. And so when you're looking at buying the dips, part of our foundational market concepts, right? During the markup phase, you're looking to buy the dips on these rotations. In a markup phase, you look to buy dips and then look to hand them off. Buy dips and hand them off. And so that's the idea. And so I wanted to show that it's kind of counterintuitive. When you're looking at a footprint chart and you're looking to buy the dips, you want it to be red on the pullbacks, red on the pullbacks. And that's typically the idea with regards to looking for these confirmations of these rotations. Now, if we look at something like selling the rips, it's the exact opposite, but very similar. So once price gets going in a markdown phase, counter trend rotations, you want them to have large buy imbalances. And those large buy imbalances, if they don't get paid, result in sell stops coming out. Then a counter trend rotation, more buy imbalances, they fail to get paid, another rotation as the sell stops come out. In this case, it was great because price comes into an area. This was 104.40 again. Crude oil trading way up there just a couple of years ago. 104.40, we're trading those areas, and look at how all of these buyers here couldn't get price to go up, and it rotates down. Then price comes up again, and look at all these buyers try to get price to go up, and it fails one tick shy. Remember when I talk about a level and having perfect double top? Then there's the one tick fade. We just saw that example. And in this example, it's the lower high rejection, right? And so this is what we're seeing right now. We see the rotation, the lower high. So that's the early part. That's still too early sometimes. But this right here is where everything goes, big time lower. That's a big time push right there. And so you can see that when price is rotating downward, this is support right here. So at support, you would expect bulls to defend and rotate it up. But in this case, what happens is lots of buyers, aggressive buyers come in on the footprint. These are aggressive buyers using market orders. And in this particular case, buyers could not get price to rotate higher because larger passive sellers were using sell limits. And from there, it dumps price downward. So this is really the major point right here that confirms the sell-off. This starts the long liquidation. This triggers the confirmation of the long liquidation, and then all rotations with buy imbalances are then opportunities to fade. Okay, so I wanted to make this important point right now. For the most part, as traders, until you find your way, you're trying to figure out what your routine is. How do you look for opportunities? What does trading look like? Define trading for yourself, right? And oftentimes, what makes certain traders so good at what they do is not so much having great, reliable indicators or perfect precision in terms of finding pivots or prices. Think, for example, someone like a floor trader. Instead, what makes them so good is understanding who's positioned where and how to run the stops. And so what I want you to start getting used to doing, especially with regards to looking at a lot of these key levels, is to start understanding who's controlling a certain move and if those participants are going to see a counter swing against them. And so that usually happens a lot with overnight trading. So I wanted to show some examples here where the overnight trend gets squeezed by a counter participants, and then from there that counter swing gets double counter swing by another market participant. So this is what this example is about. Number one is we're basing this off of the overnight pivot. So the overnight pivot is the important pivot in this scenario. And what I want you to focus on is right here. Basically, number one, you see this gray line is when after hours trading begins, and you can see price goes up immediately and then immediately sells off. Immediately sells off. And so price drops and trends lower the entire overnight session, after hours, basically, after hours. And so if you were a bear and you got short during this entire move here, when the European traders come on, the European traders at 3 a.m. come on and say, well, you know what? These traders have been short the entire time. When 3 a.m. comes along, let's take the overnight pivot bid and let's run their stops. And that's kind of what happens here. That's exactly what happens, right? So bears sell the after hours move down, and then the Europeans, when they come online, they look to take the overnight pivot bid, and they look to trap any late bears to the move to spark this short squeeze right here. That's what's happening. So for the most part, if they got paid here, then when they come online, they want to take that money back, right? And then if you look here, you can see that after the Europeans came on and took the overnight pivot bid, when the U.S. market comes online, which is this dotted line right here that references the open, when the U.S. market comes online, what do they see? The U.S. market sees that the overnight pivot off the algo right here went bid, and the Europeans got paid all night long and all morning heading into pre-market. So what do the Americans want to do? Well, we want to defend prices at and above the open in order to run the stops all the way back to the overnight pivot. And this one happens to happen all day long. Every attempt to and above. The open was defended until finally they forced the downside stops from the overnight move and pushed price right back to the overnight pivot. So I wanted to get you into the habit of identifying who is in control and are they too long or too short. So one of the things that was great about the Mr. Top Step room was, a lot of traders always trying to keep their finger or thumb on the pulse of, is the market too long or too short right now in overnight trading? So if this is considered too short, they're any late participants now are getting greedy. They're the first stops to come out, and then you see a stops run against the entire move past the previous high. So it's basically, these bears getting paid. You get the hogs getting slaughtered on the way up as these bulls get paid. And then over here, you get the counter trend traders trying to slaughter the hogs in the opposite direction. And so it becomes kind of a battle of who's in control of what and where. And the overnight pivot is a great, great pivot for seeing that overnight participation at times and who's long where and where the stops are and those types of things. So when we look at more examples of the overnight pivot, you'll see a lot more clarity around this pivot at times with regards to who's controlling it and what's the likely next move is going to be with regards to defending that level or watching a squeeze occur. So pay attention to the overnight trend, right? Understand who is getting or who has gotten paid during the overnight trend. And then from there, look to run those stops, right? That's the idea. Understanding who's getting paid, who has gotten paid during the overnight trend can be a huge clue as to what may happen after the RTH open. So again, look right here. This is number one. The bears got paid in overnight trading. Bears got paid. You see all this right here? That's the after hours trading. And the bears get paid on the way down. And that tells you right there that with these bears getting paid, there's going to be an increased inventory of buy stops above. Because these sellers right here are moving their stops down, they're moving their stops down. And then what happens here is the U.S. market comes online right here. That's the open. And immediately upon coming online, you can see sellers defending, defending, defending. And all of these rotations are leading to new and new lows. Modest, modest new lows. But what's happening here is the overnight bears got too short here, even if it was by a little bit. Too short, could not find acceptance below the previous session's low and the open. And then right here you form a little box reversal. And basically when the stops come out above the open, you start to trigger all of the shorts that were in this move, and you see a huge move right back to the previous session's high price. That's your number one idea. You know, if you see the open price here and it's being defended, 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 but it's not really seeing a continuation. Instead, you're seeing failed range expansion, failed range expansion, failed range expansion, right? That's telling you that the market is rejecting those lows. Watch for the stops in the other direction. And when that happens, it can be a massive move. It can be a massive move, especially if this has been a couple of days of buildup, right? So you have to pay attention to the overnight move again. If the overnight bears got paid and now all of a sudden you're starting to see signs of rejection, then the market may look to gun for the stops of those participants that got paid in the overnight move and look to run it the opposite way. So that's why I say you have to pay attention to who's in control of certain moves, because this is how professionals approach the market. They're looking to hunt for stops. They're looking to hunt for stops that will spark momentum moves, either via short squeezes or long liquidations, because those moves are most fruitful. When the market participants are running for the exits because their stops are getting hit, that creates the biggest moves in the market. So identifying when participants are becoming trapped at these kill levels becomes extremely important. So you can see again, this trap here happened as a result of the open and the previous low. And those again are very important prices here. So when the open price, here's a key tip. When the open price forms at the extreme of an overnight move, it's high odds that you're likely about to see a fade of that move. For example, if prices have been bid all overnight and pre-market and the open's up here, you're likely going to see that thing go against. Likewise, if the market's been trending down and the open is somewhere down here near the lows, you may see that thing go right on up. Remember, it's about who's in control and where are the stops. Because down here, it stops going down, so now the upside buy stops are at risk. And that's what happened here. Overnight control, stop going down, buy stops here, big release of energy there. Here's another look at it, and this is a different one, but the same concept. This is intraday analysis with the current session's RTH open, and this is the box reversal. And the box right there is fantastic again. And the box reversal, whenever a box forms at a key level or beyond the key level where you're trying to see acceptance beyond that key level, if those market participants do not get paid, the stops right above the box can be enormous, lead to major, major moves. And so the idea when this forms, You see again, here's the open price right there. And price immediately goes offered at the open. But there's not much distance between the open and where the low was. It immediately had to rotate back to the open to entice more sellers to enter the market. That's a big clue right now for me, if this thing is going to break. Because this is what Tom mentioned earlier. If you have a pivot, how much spacing do you want to see before a retest? If you're breaking through a pivot, you need to see a decent move in that direction after the break and create some spacing between that pivot and the next retest. And then it becomes a better opportunity to defend. In this case, what's happening is price pushes through the pivot and immediately cannot go lower and needs to return right away to defend and try to fuel up some more bears. And then it goes and immediately upon one new low tick right there has to come back to the pivot again and ask for permission to get more fuel to push lower, right? This is like a car that's running out of gas. Running out of gas has to keep fueling up, but there's a hole. There's a hole in the gas tank, and it ain't going anywhere. So when you see a rejection time and time again, a box forms, on purpose. It forms because there is passive buyers there. There are limit orders. That's why this box is forming. There are limit orders right here sitting on this level of large passive buyers that have, an iceberg order for perhaps. Maybe, this is crude oil. Maybe they have, 5,000 contracts they have there sitting there as a limit looking to fill. And if that whole order doesn't get filled, then you know what's happening, right? It's eventually going to absorb everything and run the stops. And so the reason this happens is just, again, those market participants are not getting paid. A box forms. Your idea or your goal is somewhere on the second or third rotations to look for a squeeze opportunity. Ideally, you want to be looking to get in on ahead of the actual squeeze event. But if you cannot, then the first pullback after the squeeze offers great buy the dip opportunities until proven otherwise. So this is a great opportunity. Again, forms all the time in all types of charts. And this is what I mentioned before. It's all about identifying which levels are bid, which levels are offered, and then looking to return those prices back to another price point that the market wants to trade. So this was the open price, rejected below it, so it returns right back to the previous low and previous close. Done, right? That's your trade. And so just understanding how to incorporate these various prices and mix and match them, because all the other prices in this chart are irrelevant at this point, because this is the most important price levels. This is where the market is engaging, this level, and then it's returning it perhaps back to the gap, right? So very nice the way that played out. Is an early box a tell sign that you can ride it up for the day? That's a great question. Is an early box a telltale sign? And basically, I would say sometimes yes and sometimes no. It depends on where it's happening and which type of level. I think if a box is forming early below a previous week's key level, for example, like a previous week's low, then not only does it have the potential to rally the rest of the day, but it perhaps has the potential to rally the rest of the week. So it depends on the key level and how much time or duration is building up at that level. So what we saw before was crude oil, and we had a key level at crude oil, and it was the 25% weekly expansion target. And price was trying to hold below it and formed a box. And it built out the entire day because it was building more energy for the resulting squeeze. And eventually, this thing led to a major squeeze after that box completed toward the end of the day. But this one took a long time to form, and I was expecting it to break earlier in the day, but instead it just geared up and juiced for longer. So sometimes they break, sometimes they don't. I think the longer they take and the more significant or prominent the key level where it's forming, the more significant the reversal. So the fact that if price is holding below a previous week's low, the previous week's low is much more important than a current day's open, for the most part, on a grander scheme of things, on a swing basis. This is a one-day data point, whereas this is an entire week data point. So for price to come down below here and hold, not only would it rally by the end of the day, but you'd probably see a 2 or 3 day move based off of it. And with regards to that crude oil chart, we've never come back to that data point after we formed that box. We're still much higher and never ever came back to retest it. That's how powerful this can be. But again, it just depends on the size of the move. This was much smaller. You don't oftentimes expect a huge move out of a smaller box, but it happens. Are there precise parameters to define a rotation? When I'm looking for this right here, I don't want the box to get too big, and I want the initial retest to be quick. So in terms of like exact precise rotations, not yet. Maybe I can work on something like that in terms of parameters. But you see this pivot right here, a quick move down, and it doesn't, I mean, this is not a decent move. And instead it has to rotate and retest and retest and try. Each new low is faded within a tick or so and immediately rejected. So those are usually the indications, is that you see price trying and it can't. You see price trying and it can't. Eventually it doesn't take long and you're gone the other way. So I'll look to see if I can define more precise parameters, but again, those descriptions of those characteristics there really play well. I mean, not much of a move in that direction, quick retest right away, failed rejections on these lows. Oftentimes, the best idea is just to watch for this box and wait for this squeeze event. If you just wait for that squeeze bar, you can enter on the retest entry after the squeeze bar and ride it up. You know, a lot of my best early algos that I did, my first ones, were looking for momentum moves based on stops. And what it was looking for was just these large block bars occurring out of a congestion. And from there, looking to define retests using midpoints of those areas. So if price pulls back, you're looking to engage and go. And so again, it's locating where the stops are. And so there's many different ways to engage it. I don't want you to ever feel like you have to engage it at the best point on the chart. You know, there are certain points, I would say, you know, super advanced entries, novice entries, great pro entries. You can get in all along the way. It just depends on how you want to do it. Typically speaking, on a box, you're looking for a second or third rotation entry, or a squeeze, or the first pullback, or any pullback along the way, as long as this thing remains with conviction in a certain direction. Here's some more of the box reversal setup. This one doesn't have a whole lot of explanations, just because I want to show you that it can be very, very simple at times. Very simple. And it's more about waiting for price to push beyond the key level. And that's really what hindered me early on in my trading career, was the inability to establish, you know, when a market may fade and reverse like this, or waiting to see if a market was going to do that, right? I was always eager to trade this instead of being patient and trying to wait for this and this, depending upon whatever the overriding market's doing in terms of order flow. You know, sometimes you get this, sometimes you get this. But the idea is, if you're patient with your opportunities, you typically see these form. And if you can see a box forming, in this case beyond the previous session's high, and can't hold, that implies a rotation downward. In this case, it was short-term based, so it wasn't that big of a move, but still, great idea and trade location, and a move to scale in. Here's another one where it forms another little box, another rotation, another little box. Well, this was not so much a box, but still defending in the same zone, and a rotation. Those mini boxes still mean a lot, and remember, they're double tops with lower highs, or double tops with higher highs, or double tops on the button. And, you know, I just want to show you that it can look like many different things. Over here, this one is the most significant, where price is holding above the previous session's close and the previous session's low, and it just can't go. You see a pattern here: high, lower high, lower high, and then the stops give out right there, and then it's a quick move right on down. So looking for these little opportunities, again, when it comes to identifying how to engage some of these levels, oftentimes it's all about failed range expansion. It's one of our foundational market concepts, failed range expansion. If the market cannot see expansion beyond the key level, all of those participants in here that were trying to get price to hold above here now get their stops run, and the downside sell stops come out, and you see a momentum move triggered in the opposite direction. So again, it's all about identifying range expansion, failed range expansion, and some of those core concepts. If price is trending up in the buy the dips fashion, we know what to look for at these edges. If we're, price is building a box beyond the key range, we know we're looking to hunt stops, right? So you're hunting stops. Are these market participants winning? Are they winning? No. Okay, then I'm going to look to run the stops below it. And there's many points where you can enter that as well. Again, you can get in on the second or third wave here and try to run it down. That's harder until you know what you're looking for. And then there's right here where price breaks through a level and defends and absorbs off that level before it drops. And if this level, again, contains imbalances, buy imbalances in this case, that could help trigger that move as well. All right, this is a quick slide showing the initial balance, and this one is really important just because of the pivot width analysis element. Remember, we talk about pivot width analysis, just the width of a value area, the width of a given value area, however you define that value area. If that value area is very narrow, you should expect expansion. If the value area is moderate to large or wide, then you should expect balanced trading range activity. And so this is one where, I don't know if you always pay attention to an IB width. You should. But you can see right here, look at this. This is the IB high and the IB low. So the initial balance high and the initial balance low. Number one, this forms an inside IB range. So the IB from this session was narrow and formed inside the IB from the previous session. You don't see that all the time. But not only did it form inside, but look how narrow this little range was. Very, very narrow range. Whenever you have this narrow of a trading range, there's no way, there's absolutely no way that the market can conduct business. Remember, the market is around to facilitate trade between buyers and sellers. There's no range in here to conduct and facilitate trade. So in this case, the market will look to seek expansion to either widen the range or embark on a price discovery phase. And so in this case, price pushes through the IBH, comes back, and is defended on a couple of rotations before seeing a massive squeeze event. A program trend day ensues, a program trend day where counter trend rotations are very, very modest, and the primary trending moves are much, much more prominent and well-defined. And when you're in a counter trend day, or rather a program-driven trend day like this, you have to identify right away that it's a trend that's program driven, and you cannot fade ahead of those levels. You have to be very, very careful, and you look to defend rotations, counter trend rotations for a continuation. But a very narrow IB leads to expansion. Remember, foundational market concept. Compression leads to expansion. Expansion leads to compression. So after this expansion phase up, you would expect prices to perhaps form a digestion or trading range day. A rather wide IB forms the upcoming day, and that sets the stage for a nice trading range market in the upcoming day. So again, this is just foundational market concepts right here. Compression leads to expansion. Expansion leads to compression. The pivot width analysis, narrow range implies expansion. Wide range implies trading range activity. So that's really important, because if you're able to forecast and anticipate these events, you can position yourself accordingly and trade the right and optimal bidding strategy. Okay, here's a box reversal setup using the midpoint for the day. So this is the developing midpoint. And again, this is something I alluded to earlier. What kind of hindered me at first was always trying to fade perfect rejections at pivots or key levels, and not always understanding that price will push beyond those levels, and then a failed range expansion event will then occur. And so, I wasn't always looking for them as often as I should. Instead, for example, if the midpoint is stair-stepping higher, the idea is to buy pullbacks, defend pullbacks to that level until proven otherwise, right? And so right here you can see price pulls back to the mid, it holds, retrades back to the highs. But on the next test, it holds perfectly here, bounces a little bit, and then the stops come out, right? But when the stops come out, a little box forms here as new rotations to lows are not accepted, right here. And so that leads to the development of a small box here. And these box traders right there are basically a bunch of sellers that were trying to get price and offered below the midpoint and keep it in a downward price discovery phase. Well, when those late sellers become trapped, the buy stops come out above the mid, and then you see a big move come out in the original direction. So again, the box can be very, very important here. And pro tip, it says up here, so the box tip, the idea is to recognize right away that late shorts are not getting paid, right? That's the first thing you have to do. If this is price right here and it pushes down, that first move, you have to distinguish, are they getting paid? Because if you get this little bit of a move and already it has to auction higher, that's a first clue. And then if price comes down and ticks one tick below the previous low and can't get lower, I mean, right there, that's telling you, hey, these bears may not be getting paid right now, and we could be looking at a squeeze. And so this idea is primarily most prominent in an uptrending market. So if prices have been trending up and then price pulls back against and below a key level, then you'd be looking for a box trade. So if you're in a downtrending market and price holds below here, it may give you a decent move, but again, that's a counter trend market. So this would work best in an uptrending market. Again, if price comes back here and drops below, then it's going to work better, right? So that's something to keep in mind as well. Oh, you think you read that CL hits the IB 1.5% target 81% of the time? Wow. I had not done that study, but it's very simple to do in Market Delta. So that's something that we can check out, because stats like that are very, very important. Those are probability stats that you can trade based off of. When you know that stat, then that's how you gun for that idea throughout a given day. So that's fantastic, and that's right where you need to be in terms of identifying probabilities at certain areas. Okay, so here's the developing midpoint with regards to the if-then statements that a lot of these algos deploy at the change of bias point. So as a trader, you must constantly look for signs that a change of bias may occur, as accurately forecasting and analyzing these events can get you out of unfavorable positions while allowing you to take trades according to the new developing market personality. So in this case right here, we had a change of bias occur right here. And so price forms a higher low, rallies to new highs, can't go there. And so when it comes back to the midpoint, you would expect buying to come in. A little bit of buying comes in and it fails, and that's when price goes through. So you have a change of bias occurs right here, and the stops come out below the midpoint. And so when the stops come out, it's if a change in bias occurs. If a change in bias occurs here, and price drops to new lows, right? Then, the first rotation into the midpoint is then defended. So if a change of bias occurs, then defend the first retest. And so, again, that's the spacing you want to see right here. You want to see price push through a pivot like this, drop down with good spacing, both sides. And then when price comes back, then it's likely defended by the algorithms, by the bears. And then so price then returns back downward. And if a new low occurs after the defense and the retest, then continue defending the next retest, which occurs here, and then new lows, and then the cycle continues. Again, rejections off the midpoint aren't always perfect like this. They can be great and perfect. Oftentimes, you also see, again, what we mentioned before, where price can try to hold above it and then drop. Price can also come right to it and then drop. So there's a lot of gains, but sometimes it can be perfect, especially when prices are stair-stepping in one given direction, trending up or trending down. So the exact definition of the developing midpoint is basically the high plus the low divided by 2. So it's on a developing basis. So right here on the first bar, so on this first bar right here, you can see that blue dot right there, blue box. That's that high and that low, and that's the midpoint. And then on this new bar, you get a little bit lower low and a little bit higher high, so the midpoint updates. And then so you keep this low, and finally you put in a new high up here, and so this is the midpoint using this high and this low. And it'll continue on and on throughout the day, and updating dynamically. So the developing midpoint is nothing more than the midpoint of the day up to that point in time. And so it basically bisects the highest high and the lowest low of the day to give you the midpoint. And that point, again, is a very algo-centric key level where the algorithms really base a lot of their trading decisions and biases off of. And that's what I'm showing you here, the if-then statement that occurs as algorithms engage these key pivots. And this type of if-then statement can occur at any one of the intraday key levels that we follow. Most notably, it would occur at the mid and also at VWAP and also at the overnight pivot. But you can see this type of behavior oftentimes in other pivots as well. Okay, so here's a look at actively engaging our intraday pivots using our intraday analysis. Again, remember, the idea is to understand who is positioned where at times. Who is positioned where? Who is in control of the current move? Are they beginning to lose control of that current trend? Because if so, you could see a major counter trend swing against those participants that run the stops in the opposite direction. That is the goal for every single trade you should trade. Whether you're looking at for example, whether you're looking at trading intraday levels or weekly levels or, position-based levels, higher time frame swing levels, whatever the case may be, the idea is looking to run the stops of counterparties who are losing control of their move. And so in this case, again, we're looking to see who's getting trapped and where. And then from there, if we can see market participants that are trapped at unfair or rejected price levels, then usually you can see a great move ensue. So number one right here, the overnight move up. You see that overnight move up? A big time push. So the overnight market starts right here and price immediately goes bid. And so for the first 12 hours of after hours trading, price is quietly going higher. So right here, number one, bulls get paid in after hours trading. Well, again, remember that example? Again, when the overnight pivot forms, right here, the overnight pivot forms, and the European traders come online, the Europeans are seeing that these bulls got fed all the way up and got paid, and there must be sell stops down below. So the market got too long. The market is too long up here and can't go higher. And so you see the trap. This is a trap, and that's the overnight pivot. So that is the bull trap that the bears are setting. Price is above the pivot and can't go, and so bulls are trying to keep it above that area. Bulls are buying, buying, buying. Meanwhile, passive sellers, limit orders, they're coming in here and absorbing all of that demand, trying to keep it boxed in. Eventually, the stops come out and price goes back against the move. And so the overnight after hours bulls got paid. Any hogs got slaughtered that kind of tried to get into the move late, and you can see the stops came against the move. Additionally, this is very similar to when we talk about the open price. The open price being if prices auction lower, 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 and the open's near the low, you may see price rally in the opposite direction. This is very similar to what we saw in the market today. We had a move up, move up, move up. The overnight pivot forms near highs, and so the implication is that they're going to run the stops in the opposite direction once the trap starts to work out. And then the other thing I wanted to show here is that obviously these are many, many key levels. This is the overnight pivot. This is ETH VWAP. This is the previous month's high. A lot of key levels there, important levels that we watch all the time. And so these types of traps and rotations and reversals happen in every single one of them. And just understanding how they happen, what they look like, what to look for, and most importantly, just anticipating those levels with advanced notice that, you know what, the market may bounce at the previous month's high. I'm going to watch it. And you see the first rotation come in perfectly and hit it and bounce. Well, if this doesn't just take off right there, then you know a retest is coming. So you have to watch the retest, because if the retest fails to hold below that low, then you're getting that lower low failure that leads to a massive rally, right? And that's that, that skewed W bottom there, and it leads right back to VWAP. So you're looking to take rejection back to value. That's back to VWAP. It didn't hit VWAP perfectly here, but the idea nonetheless worked out perfectly, and that's enough to scale and get into a great short-term rotation. The other thing to look at here is part 3 right here, which is when price gets a big-time move here and the distance between VWAP and that recent pivot low is pretty wide. When that distance becomes super wide, the probabilities or the odds increase that price will rotate back into that level. And if so, given the current trend, bears are going to look to defend rotations into that level for a shot at new lows. And so that's kind of the flow of what you usually see. This is kind of just a random day here where the market is trading around these levels, and you can see the games that are happening. And so it really helps to illuminate the market sometimes when you're able to just take away the clutter, look at just those levels that the market is engaging, and then trade based off of those levels. And this is one of those times. If you have the overnight pivot and you see that they can't get traction, you're looking for this. You see a big time move that leads to a big, nice distance between VWAP and current price. The first retest likely to be defended, right? And if that's successful and you're looking for a move downward, then perhaps you're looking at a counter trend rotation off of this key level back to value, right? That's your typical trading approach as a trader actively engaging some of these levels. All right, here's the overnight pivot. The overnight pivot here, we're going to finish up with a series of overnight pivot charts here. The overnight pivot, again, is a fantastic pivot based off of the overnight algo pivot from the Europeans that they use. 3 o'clock a.m. Central Time is the pivot, and you can see right here 2064s on this day. Immediately goes bid up. Immediately goes bid, right? So if the pivot is bid, in this case the pivot is the overnight pivot, if the pivot is bid, look to defend the first retest. So when price comes back, it's defended and you rotate higher. And additional rotations will also be defended as well, especially if that level's in play. And they can oftentimes offer super accurate trade location, because look at that. If you knew the overnight pivot was bid, and you look to defend here or here, you took on 2 trades perhaps 1 or 2 ticks of combined adverse excursion, depending upon where your entry was. It's fantastic. And so just knowing which levels are in play can be very important. Because again, what I'm trying to do, and we throw a lot of information at you here, lots of different ways to enter a market, lots of different key levels to pay attention to. But the goal is always the same. It's every pivot is basically the same type of price level, and just know how to engage it when price approaches it. When price is bid, when a given price level is bid, you look to defend it. It remains bid until proven otherwise. And so on this day, where nothing else really showed a lot of great promise, one level, one price point was clearly all you needed on that day. So it doesn't have to be super hard. You don't have to engage every single move in this chart. Engage the opportunities that present the best opportunities, and then look to trade and trigger that trade with great trade management. So here's the overnight pivot with regards to a change of bias, because change of bias is so important, and a change of bias occurs all the time, whether you're talking about pivot-based analysis with regards to pivot range, whether you're talking about just the VWAP, or you're talking about the midpoint. You have to know when a market is about to shift bias, because again, you have to be able to understand that bias is going to come with it a change in prices, a change in trend, perhaps a change in trading style, going from a trending phase to a trading range phase. So you have to be able to accurately identify a change of bias. It's very, very important. And so with regards to the overnight pivot, you can see there's a pivot here, and there's an overnight pivot here, and there's an overnight pivot here. And that's an uptrending, pivot-based trend. And so when you're trending higher in this way, the idea is to defend pullbacks, right, for new highs. Defend pullback for new highs. And when price sees a pullback and pulls up or pushes higher and fails, you see, it fails to get a new high here and comes back, and then it can't muster up any strength and fails. That's where the change of bias starts to begin. And then when price returns to retest that key level, that pivot, that retest is what really confirms that level as being the pivot. And then when price closes adverse to that pivot for the first time, the change of bias is basically complete. So you have a pivot that's showing higher and higher price levels. The idea is to defend until price can't close or stay close above that pivot for the day. Once it fails to close above that pivot for the day, you're likely going to see a period of lower pivots, and now you're starting to see this action, right? And so you can see in this mini uptrend here, that's what the change of bias looked like. The change of bias was failing to stay bid and going to new highs. So then when it rotates back, it fell through the level. Once it came and returned to the retest zone, it was defended and price closed adverse to the key level. From there, lower pivot, and look at how prices came back and defended in the downtrend. But then over here, another change of bias occurs. Defended in the downtrend, but you couldn't get new lows, so price comes back to the pivot, and that's where the COB begins. Price squeezes, the retest right here is confirmed, and then from there, I don't know what happens. Perhaps we rally, but that's a change of bias. And so it's very important, again, to be able to understand and identify a change of bias at any extreme using any of these key levels. They're all basically the same. So if you're looking at the midpoint, if you're looking at VWAP or this overnight pivot, you're going to see the same type of principles. Again, if you're using the pivot range, like we did last week with the pivot-based analysis, this is a way that you would identify a change of bias within a given trend. So again, we talked about the expanding ripple and the algo ripple effect, and this is important. Again, remember I mentioned this before, that the expanding ripple is not so much a money-making idea so much as it is a money-saving idea, because you can save yourself from getting chopped up and whipsawed and taking a lot of losses. And trust me, this is from experience. It's experience knowing that. And then you can take yourself from saving yourself some money to then engaging opportunities that actually allow for some great quick momentum moves in the opposite direction, because then you can anticipate some of these rotations. And identifying any algo ripple starts with a pivot. And when this overnight pivot forms, price goes up a little bit and then down a little bit. And anytime price does that around any pivot, whether it's the open price, whether it's the previous close price, whatever the case may be, whenever price immediately goes up and below it, right there, that is your first inclination that this could be an expanding ripple. Because what's happening at this stage is that price really has no momentum right now. So it has to go up a little bit to entice some buyers to get long, and then it uses their sell stops to go down and take out some stops and get some sellers short. And then once those sellers get short, it uses their buy stops to come up and take out some shorts that were short up here. And it just runs it back and forth, continuing to get buyers and sellers in at the extremes until it musters up enough momentum that it gets an actual move out of it. So this expanding ripple, again, very important. Again, it's one of those tendencies that can help save you money, because as soon as you see price go up and down around the pivot, my first inclination is sell new highs and buy new lows. Sell new highs, buy new lows. Sell new highs, buy new lows. That's my first inclination if I have to engage it, right? And obviously, you never have to engage these. You can just wait until they play out, and then look to engage the actual move that results from its development. So again, another important idea with regards to the algo ripple. So here's another idea here, and this one is the overnight pivot with regards to it being immediately bid and also trapping after hours bears. So this is the crude oil chart. Remember crude oil? We had the big Saudi meeting, and then prices gapped down Sunday evening. Immediately those prices were offered. Pullbacks to that area were also defended. And then what happens is overnight pivot comes online. Again, those European traders see the overnight bears and where they're positioned from, and the idea is let's gun for the stops. Let's squeeze them. So price goes immediately bid off the pivot, right? And when price goes bid here, the next rotation should also be defended. And it was, but it took several different rotations before it was finally defended and price rallies back toward the previous close. Now on these rotations here, is very important. Again, if you pop up a footprint chart, you're able to then look to see, is that a large sell imbalance right there? Are these, trapped sellers coming in? Are those large buy imbalances? What does it look like at that area? And from there, you're then able to see, okay, time and time again, we're getting rejections off that zone. At some point, you begin to see the squeeze, and then the stops come out. But again, this is one of those examples that shows you how market participants will look to trap others after moves that they've been in. So basically, these are a big time gap down. So there's a lot of shorts in here. They weren't really getting paid, and then the stops came out. The retest here was defended, and you saw a completion of the move back toward the previous close. So again, another great indication and clear illustration of how oftentimes the market is mostly about running other traders out of their trades. That's all it is. So here is the overnight pivot with regards to pivot trend analysis. The overnight pivot, as with all of our pivot-based key levels, this one abides by the laws of the pivot-based analysis. Remember, our pivot-based analysis is pivot width analysis, pivot trend analysis, value relationships. All of those various forms of pivot-based analysis can be used with any one of these key levels. And so when you're looking at this one, you see an uptrending market here where you have a pivot that's higher day over day over day. And when the overnight pivot is higher in a trending market, watch it, because prices below that level are going to likely be defended in an uptrending market, right? A buy-side bias, that tells you that bulls are looking to defend prices at and below the overnight pivot and then squeezing. The next day, bulls are looking to trap anyone getting in short below the overnight pivot, and they're looking to squeeze. And they're going to continue that process until a change of bias occurs. Once the change of bias occurs, now there's a sell-side bias. And during the sell-side bias phase, every rotation to and above the overnight pivot is offered. Back to and above the overnight pivot, offered. Prints lower again, back to and above. Those are traps to be offered. So again, pivot trend analysis helps keep you disciplined to the current trend of the market. If a market's trending up, you want to buy pullbacks, right? If a market's trending down, you want to sell pullbacks. And so again, being able to identify what those pullbacks look like in a footprint chart helps. Just being able to identify what they look like with regards to a pivot-based indicator really helps, because again, you can see the indicator trending up, you can see rotations below it being defended, and those make for great opportunities on any given day. If not just for the general idea of what you believe may turn out the rest of the day. You may not actually have to trade that, but you know that that could mean this, so maybe perhaps later on you're looking to buy those pullbacks, right? If that prediction comes to pass. So there's many different ways to engage this information. So that pretty much does it for our core training portion of our part 2 intraday analysis. And that analysis, again, was designed to help get you tuned to identifying the right types of opportunities at these given levels, to kind of get you thinking in certain ways about trapping certain participants or riding the waves of stops of certain participants. It's not just about, I see a support level and buying it. It's really understanding who's defending it, how long have they been defending it, if there's viable stops beyond that level, and looking for those foundational market concepts that present themselves in the charts, whether it be failed range expansion, buying the dips, selling the rips. Those types of events are very, very powerful. And when you begin to combine those foundational market concepts with some of the precision key levels that we can find, like an overnight pivot or like kurtosis, when you can combine those foundational market concepts with those elite principles, that's when you can really see some fantastic, great moves in your favor, once you're able to identify those zones. So again, a lot of different ways to engage intraday analysis. We have a lot of great pro-style tools at our disposal, and the rest is all about identifying those foundational market concepts that occur around these key levels so that you can execute entries into these trades with a minimal adverse excursion and much more favorable excursion in your given direction. So again, I want to say thank you all so much for being a part of our core training, especially this intraday analysis. And that pretty much wraps up part 2 of core training analysis for intraday trading. So thank you all so much for being a part of this training. And again, thank you for being great participants with awesome questions. And I look forward to hearing your feedback regarding this course soon. Take care and trade well.